I'm Michael Fox, and this is the Prospector News Podcast. And I'm joined by the national investor, Chris Temple. Welcome back to the show, Chris.
Thanks, Mike. Good to see you again.
Well, yeah, it's not like we had to see each other quite a bit this week. We were both in
Yeah.
Washington at the Energy Transition Metals Forum. I should have checked my calendar and recognized that the day I was traveling home was Fed Day, and stuck around for an extra day, and we could have done this in person there in Washington. But hindsight's always 2020.
Well, yeah, but now we've got this morning, as we're recording this on Friday morning, now that we're both back home, we've got the employment numbers out and the market turning and lurching in another direction as a result of that, which we'll, of course, discuss.
Yeah, well, the market doesn't seem to really want to listen to the Fed. So, I had three takeaways from this myself, but the one that heard, was a lot of it is reinforcing some of the stuff that you and I have talked about, higher for longer, and there's no rate cuts on the table this year.
Pretty much, and that was what Fed Chairman Powell admitted a couple of weeks ago in a speech, maybe 2.5 weeks, whatever it's been now, and finally had to admit what all the rest of us have seen, and that is inflation is not coming down. In fact, it's been turning back up for pretty much all of 2024 by most metrics. And so he took market expectations from where they started the year, thanks to him, for expecting multiple, 5 or 6 or 7 25 basis point rate cuts in 2024, to then it was 3, then it was 2, and now pretty much none. And he more or less reinforced that after the Fed meeting this week. When he spoke on Wednesday, he softened the tone a little bit, tried to convince the markets that you don't need to fear the opposite, that we might actually go back and start hiking interest rates again. I don't think that's a unanimous view necessarily in the Fed, and it's going to depend on whether inflation does keep coming down or not. But what he also said Wednesday after the Fed meeting, Mike, which set the table for today, was he said that one of the things that will lead them to rethink things and maybe lead to rate cuts at some point would be if the employment situation were to significantly weaken. Well, I don't know you can fix the word significantly to this morning, but the unemployment rate ticked up to 3.9%, highest in I think 3 years. The wage gains within the employment report softened a bit to that same number, 3.9%, over the last 12 months. So it's now got a 3 handle again instead of a 4. The total jobs created ostensibly were less than had been expected. And so everybody looked at that and said, oh, goody. Now he's going to be pulled back in the direction of rate cuts. And it was like one of the commentators said afterwards, is the markets all went nuts and interest rates in the market plunged and stocks were up. The Dow was up almost 600 points in the futures before the market ever opened. Joe Kernan on CNBC said, you could have a report from NASA that an asteroid is going to hit the Earth tomorrow, but people will still be bullish today and want to buy stocks if they think the Fed's going to be pulled into rate cuts. So that explains at least today's action. I don't expect it to last terribly long, but it does underscore that there's still lots of, hope and whatnot, and lots of liquidity on Wall Street.
Yeah, definitely. And some of those other Fed chairs, they apparently didn't get Powell's memo about, there not being rate hikes, because I heard a couple of them suggest that they may not actually be done hiking rates if inflation keeps going upwards.
Well, that's true, and you can say that Powell himself technically didn't rule it out. He'd make an absolute statement on Wednesday. He said that it's highly unlikely that the next move would be a cut, but he also told us back in December that we can expect to see rate cuts before long, and of course we know that that didn't turn out that way either. So look, we all know that the Fed is flying blind. They're notoriously lousy when it comes to forecasting much of anything. And it will be a lot about just how badly inflation does percolate again as the year goes on. Commodity prices almost across the board have still got upward pressure. There has been a lot of news out in the recent past about real estate refusing to come down. In fact, by one national measure here in the US, we're at still an all-time record for the median real estate price. Owner's equivalent rent, which Powell was a little bit wishy-washy when he was asked about this on Wednesday afternoon, that is still very high, and it arguably, with many other things, understates how bad inflation still is for the average household. So, it's kind of a mess because when the Fed finally and very belatedly started hiking interest rates, the excuse all along has been that of all the mistakes that they could make, the worst one would be stopping too soon in wringing inflation back out of the economy, because that is the one malady in the economy, arguably worse than anything, that hits the average American household. And that's true. Whether they have the stomach for that, if it comes to the necessity to hike rates further, when that would arguably substantially upend the markets, remains to be seen. So, this is where the Fed's mind has supposedly been at for a while, that they wanted to get inflation back down because that's the one that has the biggest societal cost, and the one that the Fed and the politicians that they have a symbiotic relationship with will suffer for the most. We'll see. I suspect that at some point we're going to see that priority change, and out of necessity, the Fed is going to have to go back to concerning itself more with the markets than with Joe Sixpack and Sally Soccer Mom and with Uncle Fred and Aunt Martha.
Yeah, it's interesting. It's, if you take a look at the data points that are coming out on inflation, inflation's been slowly ticking upwards. Now it's starting to show in the jobs number, and unemployment slowly starting to tick upwards. These are classic signs of this stagflation period that we've been talking about for the last 2 years that seem to be on the horizon. Well, that horizon is starting to look an awful lot closer.
Well, it's here. The other news, Mike, that's been out in recent days, and there's been a lot of reporting on this, is that from McDonald's to Starbucks to Yum Brands to UPS reporting a drop in revenue, even though their bottom line was healthier. Everywhere you look, the evidence is continuing to pile up that for the average household, they are hunkering down. They are feeling a recession now, not in the future now. You and I, of course, have talked about this numerous times in recent months, that notwithstanding the rosier and I think massaged numbers on growth measured by the GDP, gross domestic product, underneath that, it's not all peaches and cream. You've had people come out, Bill Gross this last week, which is more a market story than an economic story, but nonetheless, he said that, long term, what he always touted during the period of disinflation from roughly the early 80s to a couple or 3 years ago, his strategy as a bond investor, and he was one of the biggest names on the planet, as we all know, of this total return strategy. You get a good portfolio of bonds, you're going to get your coupon yield, you're going to get some capital appreciation. That's essentially over in his mind. He by no means believes that we have seen the peak in long-term interest rates yet. And I agree with that. And I've said that many times, and I'll say it again. As a matter of fact, when the point comes that the Fed is finally dragged into reducing short-term rates, long-term rates will rise ultimately. They may, in a knee-jerk fashion, come down at first, but ultimately, when the markets get their head around the understanding that the Fed is cutting rates without inflation reined in, which would probably make inflation worse, and you add to that the obscene supply of new paper that's being issued and rolled over constantly that continues to go up, that's going to keep long-term borrowing costs moving higher. Sure isn't going to let them come down. So you add all of these things up, going back to where the consumer is concerned, everybody feels this. I don't remember if you and I talked about this in Washington over dinner or when we did last, but Larry Summers, who is a Democrat, was a Treasury official. He and some people at Harvard got together and they were trying to answer the question that the Biden administration particularly is saddled with right now. And that is with the headlines showing that GDP has still been going up. Now it's slowed down, the first reading of the first quarter this year, but still we're doing better than pretty much any other country. The GDP numbers have been pointed to regularly by Biden. The strong employment numbers have been pointed to regularly by Biden and his mouthpieces, etc. Why is he doing so badly in the polls? And the answer that a Democrat Treasury official and his buddies at Harvard came up with is you'd have thought that it was him that you interviewed recently rather than John Williams, because he essentially said exactly what John Williams' point has been for years, is that the official inflation numbers grossly understate what the American household feels. And that's why Biden is doing lousy in the polls. And he's right.
Yeah, well, it's one of the things that I said, back when it was the election was going on between Hillary Clinton and Donald Trump, the first Trump presidency election. You know, Canadians don't necessarily understand American politics in the same way, but they saw Trump with lots of lies against Hillary, and they couldn't understand how he was going to win the election. And I said, it's simple. The American public at the ground level knows that the numbers that they're being fed the government aren't true because, they say there's low inflation, but my grocery bills go up. It's costing more to put gas in my car. I've got less of a paycheck when it's done than I had before. And you know, they look at that and go, okay, well, the government's been lying to me. And that's what it comes down to, is that, when the rubber hits the road, what people are feeling in their households in their pocketbook is way different than what the government's telling them.
Well, that's right. And we were just in Washington, and when you go out in Washington, especially you go out to eat or you go just like a lot of places where you've got a local income well above the national level, you don't see it. I mean, here where I live in Florida, you're starting to see it a little bit, but still there's a net influx of population here. People have got money. There's all kinds of building going on and stuff like that. But when you get away from, locales where you've still got a much higher than average income level, where you've got a lot of retirees with money, and you just don't see the visible signs in front of you. You're starting to see things decay elsewhere. And I think that's going to continue. You're seeing people, I mentioned with the, all of the comments in recent days about even the fast food joints, let alone any place else. I mean, here in the US, even using the stronger US dollar versus what you have there, you can't go out to eat anymore to halfway decent places a couple without killing $100 bill. And I'm not talking about getting fancy. And you can easily spend way more than that if you go to an upscale place. And people are finally just saying enough. They're starting to cut back a little bit. They're not going to go out as much. They're pushing back. They're gonna eat at home. They're gonna buy the private label goods. They're gonna stop spending on things that they don't really have to have. So that's already been a dynamic in much of the country for a while. It's going to become more of one. It's going to broaden out. But here again, in some areas, that will lessen inflation. Clothing prices will probably go down or not go up as much as other things. Stuff that you would consider as toys or luxury items may go up at a slower rate. But because of all kinds of dynamics that we've talked about many times before, Mike, inflation is still going to be here for all of the things that we need in life, for utilities, for insurance costs. That's another part of the whole thing. Service inflation, as they call it. That's going up at a faster rate than the overall CPI, and there's no sign it's going to stop.
No, there isn't. The matrix that I use when I'm traveling is normally I have to travel either through Toronto or Montreal. Montreal's a good one to utilize. I call it the Starbucks line matrix because in the domestic terminal at the Montreal airport, there's only one Starbucks. And when things are busy, there's a big line to get a coffee at the Starbucks. And across the hall, there's also a Tim Hortons. I'm more of a Starbucks guy than a Tim's guy. Don't tell my countrymen. But it's the same thing. There's big lineups just to grab a coffee. And this trip through Montreal, I was two in line. And I just basically I walked up, ordered my coffee, and was done in 2 minutes. Um, and under normal circumstances, I have to stop and go, okay, do I have enough time to get through this line, grab a coffee, drink the coffee before I get to go on my plane and be on my way? And I have to justify standing in line for the Starbucks. This trip there wasn't any of that at all.
No, and I saw much the same dynamic at, at leaving National Airport yesterday to come home. Again, I think people are just, they realize that things are getting tighter, costs have risen, and, it's part of the great stagflation, to be sure. And I think where the markets still have not come to grips with what consumers have more so is when the markets still have this idea in their head that, oh, we get one batch of softer numbers for a change this morning with the employment numbers and everybody's old goody. We're heading back to disinflation and the Fed's going to cut sooner after all, et cetera. The average household understands what's going on. The small business survey from the National Federation of Independent Business out this week, sure, that puts the lie to when Powell says, well, we want to make sure inflation expectations don't become well entrenched. I got news for you, buddy. They already are. And the small business survey sure shows that. Consumers will tell you that. And, he's pretty much the last one to get it along with the markets. And I don't think the markets, and this may still play out over a longer period of time than it arguably should. I still don't believe that the markets have it in their ability to comprehend right now that inflation is not coming back down to 2%, no matter what the Fed does or doesn't do. The great stagflation is here no matter what the Fed does or doesn't do. And to me, what is going to cause a precipitous drop in both inflation and interest rates, maybe for a short time, would be that if the Fed loses control of something in the markets or some exogenous event hits the markets and you have a bunch of deflationary dominoes fall in on themselves again. And that to me increasingly is what we need to look at. The Fed is able to get away or has been able to get away for a while now with raising interest rates to the extent they have. They've, been kept at their present level since last summer when the Fed stopped, at least for now, its rate hikes. And yet we're all still here. The world didn't end and whatnot. Well, why is that? It's because there was still so much liquidity pumped into the system as a first matter ahead of that liquidity was not an issue. But what is becoming increasingly an issue is solvency. There can be lots of liquidity out there, but if you're as a household can't take advantage of that, and if your own household balance sheet is starting to get a little bit top heavy, then you're going to slow down your economic activity. You're going to spend less. You're going to go out to eat less. You're going to travel less, et cetera. Same thing is true for businesses. And this ultimately brings us to going back and looking again at exactly how leveraged the markets are. There's information out based on the Fed's latest financial stability report that shows that even if liquidity is not a problem, solvency is beginning to be a bigger problem. We've not seen that many bankruptcies yet among banks. We had Republic Bank go bust recently, which, funny story, folks, Republic Bank of New York, which was one of their branches, was a key player in one of the most spectacular short-term trades I ever advocated in the gold market back in 1999. Go to my website and look that up. Pretty cool story. I was able to retell that story, in fact, Mike, the other night in Washington when we all left the National Press Club and a few of us went over to the University Club. And the guy who was a longtime member of the University Club passed away some years ago, was a good buddy of mine back in the day, and he was the one able to confirm for me some of the inner workings of the gold market back at that time. But I digress. Republic Bank came back to my mind recently when they were the latest bank to go under about a week and a half ago. Hardly a blip. Nobody heard about it because they shorted all up over the weekend. But there are more coming. And by some figures, there's over $20 trillion worth of off-balance sheet obligations in the banking system that are in some trouble, especially if interest rates do stay elevated, and that needs to be rolled over, refinanced and whatnot. And when you had that at 75 or 80 basis points, and now your new paper is going to cost 5% plus, it's like the robot said in Lost in Space, this does not compute. So we've still got that staring us in the face. And I think that's the reason why, if they thought they'd get away with it, the Fed would like to be able to reduce interest rates. But I don't know. I don't see that happening until enough of these things occur, as far as the market breaking, and whatever the inflation number is or isn't, the Fed is forced to cut rates. And here again, when you look at this morning's activity, not to drone on any longer, that's what these people chasing stocks higher and knocking yields down again just don't get, is that be careful what you wish for, because even during normal times in history in these Fed cycles, by the time the Fed does get around to lowering interest rates, you're already going into recession. And the performance in the stock market specifically is far worse after the Fed actually starts making those cuts. So be careful what you wish for. I think that's going to be doubly true this time.
Yeah, let's take a look at liquidity and solvency. Because the Fed, I mentioned there's the three takeaways. I mentioned two of them. The third one that I grabbed a hold of was, and this kind of slid underneath a lot of people's radars, their balance sheet tightening. They've gone from tightening by the tune of $60 billion every month to $25 billion every month. So they've reduced the amount of money that they're tightening, so they're going to try and maintain liquidity in the system. Based on this conversation up to this point, are you thinking that they're seeing something that might break in that front and they need to be prepared for it?
I think that's likely, and Powell kind of half admitted that, when the Fed in their official statement came out, and this actually didn't come about this week. They've been hinting at this for the last meeting or two, that they were going to reduce their runoff rate. So specifically, they were allowing a net $60 billion worth of treasuries to come off their balance sheet each month. As of next month, June, they're going to reduce that number to 25 billion. And they did say it's to maintain orderly trading and behavior in the markets. In plain English, that means they're concerned that they don't want so much net selling of treasuries that, all else being equal, that all by itself serves to drive up borrowing costs even more than is going to happen otherwise. I think it also acknowledges the reality today that there is much less foreign demand for treasuries right now. More often than not, foreign investors want dollar assets and they want treasuries, but that has started to change for a variety of reasons. So the Fed, if they're going to end up being, which they essentially are anyway, the buyer of last resort, that means they can't be selling as much. If they aren't going to help out the treasury market, and nature takes its course entirely, who knows how much you would see yields move higher on treasury paper. So that's going to happen anyway, I think, at least until we get to the point where it becomes so bad that the Fed and or the treasury are forced to consider what's called yield curve control, which they're trying to get out from under in Japan. We may go into that environment at some point. In one more acknowledgement of that came out in the news this week, I don't think the numbers are that large, at least yet, but the Treasury Department, independently of the Fed, is going to, this month, they are reinstating their so-called buyback program, where the Treasury itself is going to buy back treasuries. Now, the question really becomes, in that sense, with what? But those are the kind of people you got running things. And folks, if you haven't seen it yet, and this is a perfect time to bring this in, do a search on Google, go to Twitter. You've probably already seen this 4 times this morning, like I have. But Jared Bernstein, who is one of President Biden's big economic gurus, was interviewed by someone and was trying to explain how money comes into being and attempt to answer the question, why is the public borrowing money in the first place for what should be the public credit? And when you listen to the ranting, incoherent answer from this babbling idiot who can't articulate, if his life depended on it, how all this works himself, we're screwed.
Yeah, show me a government official that can explain their programs so that it makes sense. Of course, we're screwed.
Well, I thought Janet Yellen was a dumbest numbskull on his economic team, but Bernstein this morning has given it a hell of a try to displace her.
Well, somebody had to say hold my beer while they talked about, trying to outdo Yellen, right?
Yep.
Well, I often look at this a little bit differently too, as I look at the Treasury buybacks and the stuff that the Fed was involved with, and I see them almost, the old adage about borrowing from Peter to pay Paul, and I see the Fed as being like the intermediary that's allowing that to happen, and I'm wondering if that's not a way to shore up the Treasury, and that they're having to dump, well, not dump, they have a number of bonds that are coming due at very low interest rates that are going to have to replace by bonds with relatively much higher interest rates. And that the Fed's going to have to pick up some of that liquidity so that the government's essentially borrowing from itself in a lot of ways. Is that possibly an impetus for the move towards slowing the reduction of the balance sheet?
Oh, it's just certainly a step in that direction. I mean, we're not so bad off yet that the Fed has to show its hand in a much stronger way. But let's not forget that when you have a country whose deficits are just so horrendous, at some point the market doesn't want that debt at any price, and the central bank has to do it. And I mentioned a minute ago the example of Japan, and they're trying to get out from under this now. Not going to be easy, if it's even mathematically possible. But for a long time, the Bank of Japan was buying. I mean, when you net it out, something like 80% of all of the on paper public debt owed by Japan is owned by the Bank of Japan itself, to keep the implosion of financial assets that started back around 35 years ago from getting any worse. Along the way, the Bank of Japan also was buying stock index futures, parts of companies. They didn't make any bones about it. They didn't try and hide it. They didn't do what surreptitiously, I think, the Fed and or some of its minions have done from time to time, and they have somebody that's 1 or 2 steps removed, so they have some deniability, will step in and try and support the stock market. I mean, Japan did this overtly. They had to. But the advantages that Japan had when they did this is that the economy in Japan, much more so than the US economy and markets, was a lot more insular. Okay, the country is much more homogenous in Japan, culturally and otherwise, and everybody's values. And so, inflation wasn't the problem when Japan was doing this as it is here in the US. So they could get away with keeping a lid on interest rates and having essentially no return on assets, and compelling much of the country and the country's institutions to hold this non-yielding paper because it worked. Okay. I think it's going to be a much bigger challenge for the Fed to do this when inflation is still going to be running hot. And I don't think, again, the whole lot's going to change that. what did the Fed and or the Treasury do down the road? Inflation is 4 or 5%, and now the math doesn't work anymore for the government to pay interest on that level of debt. And so they come out and say, all right, from here on out, that doesn't matter what the inflation rate is, we're going to pay 3.6% on 10-year treasuries, and we'll pay 3.7% on 30-year treasuries, and you're going to take it, and you're going to like it. And it doesn't matter if you're a top-rated corporation and have to pay 8% for what's left of the credit out there. Okay. The government is going to say, here's what you're going to get. You're going to take it. You're going to like it. And they'll have some power to do that because you've got a lot of pension funds, a lot of insurers and other things that are related to actuarial tables. They'll be able to compel an awful lot of people to take a well below market return for the paper. The problem in a bigger way will be what that does to the economy in a bigger way, because again, with the Treasury's appetite so voracious to issue more debt, there's not going to be a whole lot left over for everybody else to fight over. And so you'll have a very stark, kind of like two-tiered system. I mean, already you have different borrowing standards to pay, based on a lender. You got corporations that might be rated AAA, you got ones rated as junk. The AAA corporations can borrow money at a lot less than if you're junk rated. I mean, it'll really dry up for junk rated companies. I mean, good companies might be paying double-digit returns. The other dynamic is going to be when it comes to mortgages. Is this going to filter down to the hoi polloi when it comes to mortgages as well, and we're going to have to settle for much higher mortgage borrowing costs. So, there's a lot of open questions and unanswered questions with all of this, Mike. But the overall landscape is higher inflation for a lot longer than people expected, higher borrowing costs, and it's how all of these things evolve, and I think arguably get worse as the time goes on. That's going to impact the markets more so than what we're seeing right now.
Yeah, definitely. And one last thing before we start to wrap up this discussion, because what discussion about economics that we can have without the other elephant in the room, which is China and its gigantic debt. You and I were discussing in Washington that they're seeming to be telegraphing that they're about to do a major devaluation of the Yuen again.
That's quite possible. In fact, it's likely for a variety of reasons. It's been well known and well reported by us and others that China has had difficulty in trying to figure out how to service its gargantuan debt pile, public and private alike, which when you add it all up, don't forget, folks, that China has got the world's biggest debt to GDP ratio, more than Japan, more than the EU, more than the US, and pretty much everybody else. So the way in the end, which, you can talk about China being authoritarian or communist or whatever epithet that you want to use from people who have an agenda in describing them that way. All you need to do is look at the simple math, and that is that the only way in which China avoids a major deflation and economic debacle is by devaluing their currency and going back to more overt inflation. And that's what they're preparing to do. Now, it's going to involve some pain along the way. But for those of you who have wondered why this has happened, it helps to start answering the question, why has China been buying so much gold in recent months? Why have they been stocking up on oil and certain other commodities? Well, it's because when they do devalue their currency, it's going to cost them a lot more of their currency to buy these same things. So get it out of the way to some extent before you cheapen your currency, and then you don't need to buy as much right away. That's all going to have implications for the markets in various ways, which is a whole other discussion that we can have down the road.
Yeah, no, definitely. And I think that'll be a discussion that we could probably fill up an entire podcast on.
Oh, for sure.
But it is something that the Fed's going to have to watch out for. Now, if China does that, what is the likely Fed reaction going to be?
Well, it remains to be seen, because if China devalues the balance of payments, arguably, at least for a while, becomes worse. Politically, it's going to really turn the heat up because, don't forget that China is still trying to export its way also to some greater economic health. If they devalue their currency, of course, that helps to foster that as well. One of the subjects that was covered when we were at that conference in Washington, and is being covered at least somewhat during this political campaign season here in the US, is that China's exports to the US, now more of them happening indirectly, are as great as they have ever been. So you've got former president, would-be renewed President Trump, suggesting he'll put major tariffs on imports from Mexico that could be identified as actually imports from China. Because one of the reasons why Mexico has done so well and why the Mexican peso is one of the only currencies that has risen a fair bit against the US dollar for a while now is because their economic activity is booming, not just because of what they're doing, but because China has set up umpteen different varieties of subsidiary companies in Mexico to get around US sanctions that were in place from Trump, and some of which Biden continued. So now these things are called imports from Mexico, not from China. Well, Biden has tolerated it. Trump said he never would have tolerated it. Biden is saying, well, now that I know this, maybe we're going to stop it. So it's going to lead to more of what the media will call protectionism, or whatever term you want to use. That's going to have largely negative economic connotations. It's also going to be one of the many things that will undergird this rebound in inflation, because whatever else you want to call it, a tariff is a tax and it raises costs.
Yeah, so that'll just make the Fed's job even a little bit more difficult, won't it?
That's right.
If people want to follow you and your musings on economics and commodities, where will they find you, Chris?
Simply go to nationalinvestor.com on the internet. If you're not already on my mailing list, make sure you sign up.
Perfect. I look forward to having you back on this podcast, probably sooner than later, and we'll really start to dig into the Chinese Yuen and what might be happening on the horizon there.
Well, we definitely need to, and especially as that all impacts on, America's, specifically in North America, generally our own nascent EV industries having hit the rocks in the recent past. There are some renewed efforts to try and do some more sensible things as far as permitting and building supply chains. But the sad fact of the matter is, more so for me being an American, Mike, is that not only on fossil fuels, but even on a so-called green transition and whatnot, we have actually, in most of these areas, lost more ground to China in the last 4 years. We've not been closing the gap, and so we've got a deeper hole to get out of.
Well, as a Canadian, it's the same diff. The old adage, if America sneezes, we catch a cold. So
Yep.
it's been a pleasure. It was good seeing you in Washington, and I look forward to having you back on the podcast soon.
Absolutely. I'll enjoy that. Take care.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.